Yo, what's up, guys? Today we're gonna be going over some offerings, offering types, and in general, like why companies do it, how they benefit, and just different types. So first things first, usually a company would need to file a shelf registration with the SEC. I'm not gonna cover that today. What a shelf registration exactly is, but they need to have that in order to have offerings happen. So let's get started. So first type of offering is a direct offering. Let's see. So a direct offering is basically where a company sells shares without using a broker, and it just sells them directly to the public to raise capital. So they don't go through a broker and hire them. But a public offering, on the other hand, goes through a brokerage and hires it to raise money for the company itself. And what the brokerage gets out of this is commission and fees. So a public offering, basically, a brokerage is hired to raise money for the company in exchange for commission, for fees. That's what a public offering is. A direct offering, a company sells shares without using a broker, and it's just directly to the public to raise capital. So, okay, so and why does a company have offerings? So why do small caps have offerings? Small caps have offerings to raise money, whether it's for future projects, whether it's for debt, for anything. They can have offerings to raise money so they can have that cash. So when an offering happens, it adds more shares to the shares outstanding. So this is the shares outstanding right here, and let's go. I'm on ticker SOS right now, and let's scroll down all the way right here to where they had this offering, December 22nd. So let's see. Under the terms of the securities purchase agreement, the company has agreed to sell 2.6 million shares of common stock and warrants to purchase 2.6 million common stock. But this is the key right here, 2.6 million shares of common stock. So when we go back, to the shares outstanding, what happens is that these 2.6 million shares are added to the shares outstanding. And when the shares outstanding goes up, the price goes down, is basically what happens. So when an offering happens, the shares that are sold, which is in this case 2.6 million shares of common stock, that gets added to the shares outstanding. And what happens is the price goes down. So December 22nd, which is right here, it's right here. What happened was they had the offering, and the stock completely tanked, almost $1. And I was still holding at this time, so the stock completely just dumped almost $1 because of the shares outstanding, because more shares outstanding came and they diluted those shares. So when they announced this offering, they announced that they were selling 2.6 million shares of common stock, and it was a registered direct offering. And so when they announced this, it dumped almost $1, as we can see on the chart right here, this gap down. And 2.6 right here, 2.6 million shares were added to the shares outstanding. So that's basically what happens when an offering comes out. So let's go over shelf offerings. Shelf offerings. Let me see what we're. Okay, so let's see SOS. We'll do SOS. So for shelf offering, we're gonna be looking for F3 or S3. Those are the two forms. So F3, this form would be good right here. So let's click view. So let's go over what a shelf offering is before I go through this. It's basically when a company is planning to price the offering later on, but they're not going to do it right now. So no dilution is going to occur, but they're planning to have an offering later on. So they'll dilute later on when they need the cash, but for now, they're just getting ready. So why does a company do this? Why does a company have a shelf offering? They do this so that they can get rid of all the paperwork and do it right now, so that when they actually do need the cash later on in the future, they can snap their fingers and have the offering out. They don't have to go through files with the SEC. They already have it all done from this shelf. So this gives people like a hint, oh, an offering is coming later on. So that's why a company has shelf offerings. Now, once they file to register these shares, they're ready to have an offering later on. So this can give people hints that an offering might come. And at the same time, it opens up many opportunities for buyers to come look into the stock. It attracts attention as well. So this is good for the company because it gets rid of all of the paperwork that they have to do when they do want to do the offering. That way, when they actually want to dilute, they can do it really quickly and not have to worry about all the BS paperwork that they've already gotten out of the way with this shelf offering. So, title of each class of securities to be registered. So they haven't been registered yet. So let's scroll. Okay, let's see. So here's the amount to be registered. Let's see. We may from time to time, in one or more offerings, offer and sell up to $300 million of any combination together or separately of Class A ordinary shares. So what this is saying is that anytime in the near future, because of this shelf offering, they can offer up and sell up to $300 million worth of Class A ordinary shares together or separately. So that's basically what a shelf offering is, and it's good for the company because, no paperwork. When they actually do want to dilute, they get the paperwork out of the way right here. So yeah, that's what a shelf offering is, and these are 6K. I don't know what that is, but yeah, so that's it. These are the SEC filings. And there's an education tab in our server. It's under the education category. Let me check what it's titled. Give me a second. It's titled SEC forms, and it has most of the SEC forms there. 10Q, 10K, registration statements, all of that stuff. So I would definitely recommend you checking out the SEC forms channel in our server. But yeah, next let's go over at the market offerings. So let's go over at the market offering. So I think SOS might have had, let's see, if they didn't have an at the market offering, we'll do another stocks. Okay, here we go. So they did recently too. So this was the 18th. This was like 5 days ago. Let's see. The company has agreed to sell 8.6 million shares of common stock and warrants to purchase. Okay. At $10. So this is $86 million worth of its American depository shares and warrants in a registered direct offering priced at the market. So at the market offerings. So what this is basically selling shares during market hours to the public. So that's basically what at the market offerings are. So when it says priced at the market, the company's selling shares during market hours to the public. So what do you need? What does a company need to do this? First of all, they need a good amount of volume because you're going to need to be eating up these shares that the company's selling. So you can't just do this to a dead stock. That won't work. You need a good amount of volume and good amount of activity throughout the day to do an at the market or an ATM offering. So once you have the volume that's needed, you can basically sell your shares to the public. The company can sell its shares to the public, but it sells it slowly. It doesn't just send out all 86 million worth of shares and just sells it like that, because that would absolutely tank the stock. It goes slowly. So it just starts selling slowly by slowly. So it cannot do much damage to the stock. Otherwise, the stock would absolutely tank. So it just does it slowly and without much damage. So this is basically a priced at the market. So when it says priced at the market, they're going to be selling their shares during market hours to the public. And this is 8.6 million shares of common stock. But yeah, that's pretty much it. For price at the market. I believe that ATM offerings are also cheaper for the company. I would have to double check that, but I'm pretty sure I read that somewhere. So that might be also another benefit to doing ATM offerings. But yeah, let's see. I'll be right back. I'm gonna check if there's anything else I should go over. Yeah, guys. So one more thing I want to go over is that some offerings can be bullish rather than bearish short term. So let's just say a stock is trading at $2 and they have an offering for $5. This right here is extremely bullish. This will not drop the price of the stock. So I remember SOS also had one. Let me check if it's in here. I doubt it is because it was a bit, let's see. No. Yeah, so this is $4. Let's see. But I believe that SOS had some shares sold at $4 when it was trading at $2. So this was extremely bullish for me. So when a stock has an offering for a price that's above the market price that it's trading at, that's extremely bullish. But when a stock is trading at $2 and it has an offering for 1.30, this is not bullish. This could be bullish long term, but short term, this is definitely not bullish. Sorry about that. But yeah, I just wanted to get that through. So not all offerings can be bearish. Some of them can also be bullish. Yeah, guys, so I also wanted to finish off by discussing what a private placement is. So basically a private placement, the company is selling securities first. Those securities are not registered with the SEC as they are with a regular offering. So they're not registered with the SEC as they should be usually. And these private placements are sold to investors in a private offering. So these investors are different than other investors because they have to sign something saying they have enough money to lose their entire investment. And it's basically just these investors have to be special of some sort. We're trusted. They can make this type of investment and still be safe. So that's basically what a private placement is. And there's also public placements like IPOs, etc. So yeah, that's pretty much it for this video. Let me know if you have any questions. Yeah, and yeah.